Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They've also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within your IRA.
Welcome back to Golden Rule Radio this week. We're seeing gold climbing and looking forward to digging into the gold chart here in a few minutes. Gold up about $50 from our recording last week. Silver also up about 70 cents. Platinum and palladium both even, and the dollar down over a point over the last week, making the third touch below 90 so far in 2021. Finally, the Dow seemed to give us a little bit of a top back on May 10th, has dropped back down to the mid 33,000 range and has bouncing around between 33 and 34 for the last week. So getting back into the metals and digging a little bit into the charts, where would you guys like to start?
Well, let's start by saying that gold has moved up to your 1875 number that you were calling for it to come into and show some resistance here, which it is showing. And silver down today on Wednesday with gold holding firm. Platinum's down as well. I'm wondering if we're in for a little bit of a correction here as we're in May and then moving quickly into June. May and June are not always positive months for the metals. On average, they're probably flat to maybe June being down. So if we're going to see a correction, which we hope to see, would like to be buying it a little cheaper, I think that it is possible that we're going to see that in the next 30 to 45 days. So good job, Miles, nailing these numbers, 1875 gold hitting, and looking like maybe we're going to back off here. If you're going to set parameters on the upside or the down, I guess the downside could be in the 1700s, but on the upside, if gold doesn't correct, is there a number that you're looking at where you would say gold has broken out of this downward trending channel? What would that look like, Miles? What numbers would you be looking at above 1875 to say that gold's clearly out of the channel?
Thanks, Robert. So for a little bit of history, following on the August 7th high of gold pushing up well into the 2000 range, we actually started the short-term bear market in August of 2020 and then followed all the way down to the double bottom we put in earlier this year. So the 1885 first potential reversal point that I've been bringing up, that's actually just your 618 fib level. Also, it's kind of your second price point up, the second major hurdle that you have to get above on the way up. So the first one we actually broke through back on May 7th, and that would have been around 1815. This was kind of the last high gold put in before it just fell off the cliff. And then the second one is right here between around 1875 and then the 618 fib 1885. So we have to get above this price, kind of like we did back at the previous price level. We pushed above it, we came back down and retested it on May 13th, and then we've jumped back up to the next one. Now we've tested this level on the bottom. We need to break above it. We need to come back down. Old highs need to become new lows. So, long answer to your very simple question, what's the next high point I'm looking at in gold? And that's going to be between 1943 and let's say 1975. So I understand that's a pretty big range, but we had a number of tops get put in over a long period of time between about September of 2020 and then of course January of this year. By the time we get up there, I'm pretty confident we're in a bull market at that point. We pushed through one major hurdle. We've pushed through a second major hurdle. We've pushed beyond the 618 Fibonacci level. At that point, I think we're already starting to stair step up. Now, I know a lot of us were encouraging our clients to go ahead and get in at the 1675, 1680 mark, and I know a lot of our listeners did pick up some gold at that pricing. Doesn't always work that way. None of us are perfectly accurate all the time, but sometimes even a blind squirrel finds a nut, and I'm pretty happy about that pricing entry point there. So anytime we push above some of these levels, I look at those as opportunities to continue to dollar cost in and continue to stack up ounces as gold pushes up. Now, ultimately, you can't actually scream bull market till we're pushing 2100. We need to get above the old highs. We need to put in some significantly higher prices, but at that point, you're almost $400 higher than we could have gotten in recently.
Okay, so the other side of it, what if we were to see some seasonal weakness, some technical pullback in the gold price from here? Where would you set targets if we were to start moving a little lower in the next 30 to 45 days? Where would you set your targets?
Sure. So the number I like the most is right around 1760. So 1760, if we were to turn around here, which is possible, we are seeing some topping action the last day or two at this 1885 price. So short term, if we turn around over the next couple weeks, 1760 would be a dollar costing in point at lower pricing. And then after that, maybe 17 and a quarter, 1724, 1725. As you can see on the chart, that's sort of when we short-term reversed and started to push back up. And then finally, the bottom that we double bottomed at, 1675, 1680. Now, I can't imagine we really get back down there. I am starting to lean more bullish. Please don't tell Tori I said that. But I am starting to lean more bullish on this gold chart, pushing through two major levels. Well, we've pushed through one, potentially pushing through a second one, I think is very supportive of continuing the long-term bull market that kicked off back in 2015. And like we've had, it's nice to have a couple months where we get a little bit of a cool off and a chance to increase positions. But at this point, I just don't understand why you'd be waiting for any type of pullback. I mean, with what we've been discussing with the US dollar and money printing and inflation rates, I just don't get it. If you're really trying to nickel and dime pricing in here, I really think you're running a major risk.
I agree. Record gold prices have, in my opinion, already been priced in to the market. We haven't seen the realization of that yet. And like you said, when we're pushing 2100, that'll be the reality. Timing tougher to predict, but this morning you saw, great job on the numbers because you do see a lot of volatility. This is a beautiful short-term chart where you see this stair-stepping effect. And this morning you're essentially at 1852. And right at the open, you skyrocket all the way up to 1890. And it couldn't hold. It didn't last 5 minutes, and it came right down to your 1885 and traded sideways for hours, right at that top that you described. And then it ended up coming down suddenly in a very brief period of time, and that was news-driven. So you talk often about technicals responding to news and ultimately going to where you're predicting they're going to go in some time frame. Well, today it's because the Fed started talking about tapering bond purchases. For the first time, they're starting to say, look, the economy's running hot. They know now that inflation is an ongoing concern. And to taper bond purchases, yeah, gold should respond to that. That's the type of news that would cause gold to have a little bit of a pullback. But it also surged to a 4.5-month high, right? And a lot of that is safe haven demand. A lot of that is seeing the riskier assets, the stock market and the digital currency markets, start to turn down. And I think what we're seeing here too is inflation can be good for stocks. Inflation can be good for other assets, commodities in general, if you're investing in them and you're expecting prices to come higher. But there will reach a tipping point where for the stock market, inflation becomes negative. And I think that's what we're starting to see now is the worse the news is with inflation, the more the expectation now is of economic slowdown. People aren't going to be able to afford it. You have less disposable income, cost of goods of just food and fuel and your primary staple starts to rise. There's less money to speculate on and invest. Your speculative investments are turning against you. You're losing there. And so that's where inflation literally starts to have a negative impact on the stock market instead of always a positive. And yet here we start to see gold do what gold does.
Yeah, I sort of feel like you saying inflation can be good for markets was kind of like when Ben Bernanke said breadlines are a good thing. Sure, maybe they stave off starvation, but realistically, the negative cost of living increase dramatically outperforms the positive increase in the equities market, average person's 401k portfolio. And you look at the last 20 years of gold versus Dow, and gold's outperforming the Dow on average over the last 20 years just based on inflation, being, the ancient dead relic that it sometimes gets claimed to be. it's outperforming some of the more modern investments because of inflation. So I hear what you're saying. Rising tide raises all ships. But personally, yeah, I think the negatives far outweigh the positives when it comes to inflation. And I don't think you disagree, obviously.
No, no, not at all. But that's why we're such fans of diversification. Look, there's been fortunes made in the stock market just even since 2009. There's been fortunes made in the cryptocurrency market, okay, since again, like 2009. And why would we ever speak against that? It's funny how many times we get listeners to this show try to compare gold to crypto's performance. That's not what we're talking about. Those are growth, speculative, trying to hit home run type assets. Sorry. They're not the primary means of asset preservation and savings that gold is. We compare gold to cash. And so, yes, has it outperformed those markets for strong periods of time? Yes, it has. Over the course of 20 years, Robert talks about the fact that it's outperformed the S&P. Yes, it has. Does that mean you don't invest in the S&P? No. Does that mean that you always invest only in gold or never in gold? It's never a never and always type of proposition. It's an opportunity for you to not have to worry about the timing, develop a portfolio approach percentage-wise. What are you going to have in your growth assets in the form of equities? What are you going to have in growth assets in the form of digital currencies? What are you going to have percentage-wise of your portfolio in cash for liquidity and opportunity and that short-term spending? And what are you going to have in the physical metals? And stick to the plan and develop what that's going to be and remain diversified, because even this week is a perfect example of why you remain allocated in each of those categories without having to lose sleep.
Right, and that's why we like to work with our clients about building those plans, and I'm glad you used the word percentages, because from time to time you need to rebalance your percentages based on which asset class is in a position to have the most potential growth. So I love the idea, like you said a moment ago, we're comparing gold to the value of the US dollar. But there are other things you can compare gold to. You compare gold to the value of the Dow Jones Industrial Average, or in this case, to segue to some of the other commodities, you can compare gold to silver. So I do want to talk about silver a little bit today. So looking at the silver chart, as gold is potentially starting to turn bullish again, and this is something I've been saying for a number of weeks, silver never turned bearish. Silver put in a higher high last year, 2020. Silver put in an even higher high at the beginning of 2021. Now, it was only a few pennies, but it never put in a significant lower low. And as silver's now pushing back up above $28, I think that silver is finally going to break above and hold above $30 an ounce. I think it's a very high likelihood that ends up happening. The only thing pushing me in the other direction is the fact that it's building this massive wedge pattern over the last almost 12 months, and it is possible you could see a turn down in silver. Now, this may coincide with what Robert was just talking about as far as seasonal price movements in the metals. You do, during the summer months, tend to see most commodities sort of calm down a little bit, except, of course, gas prices, simply because it's vacation season. So looking exclusively at the charts outside of any external stimulus, like what time of year it is, silver continues to look incredibly bullish, and I think once it breaks through that $30 barrier, that gold-silver ratio could tighten very quickly.
I think that's going to happen by the end of the summer.
I hope you're right. I mean, may it be.
Yeah, I mean, look at July, August as being probably the time frame that metals start to really do well based on seasonality. So by July, you want to be invested. So you've got 30, 45 days here before you want to absolutely own the ounces you want to own going forward in this long-term bull market in the metals.
And then rounding out the precious metals, we'll just briefly touch on platinum and palladium, briefly because both of them are sort of stuck sideways, at least over the last week. We had a longer chat about platinum and palladium a couple weeks ago. Platinum, like silver, continues to climb, keeps putting in higher highs, keeps putting in higher lows. It's following a pattern. It's either going to see some type of exponential move up, or we're going to have a reversal back down. I don't really care which, because at this point, platinum needs to be a part of your precious metals portfolio based solely on the relative price. Again, we're getting back to this concept, seems to be a theme this week. getting back to the relative price of platinum versus gold, platinum versus silver, platinum versus palladium. And you look at some of these ratio charts, platinum is still a screaming deal compared to some of the other metals. Now, as we continue to see all of these commodities rise this spring, coming on the heels of our bigger monetary policy and liquidity and velocity discussion a few weeks ago, what is the dollar making its third trip sub 90 mean, Robert?
Well, it means that it's coming back down into that support level that has been defended around 88, 89. And again, that 88, 89 number is big support. If we break below that, it's going to be a free fall with the dollar index. I just can't stop myself from thinking that there's maybe another rally in the dollar. I know that maybe doesn't make any sense. Maybe it corresponds with a decline in the metals prices temporarily in the next month. Hopefully that's the case. But long term, that dollar index is headed way lower because of what the abuse is that's going on with the dollar.
I think that rally is going to be based on rumor and not fact. They're going to try to do some things to bolster it, like what the Federal Reserve did was saying that they're going to begin to taper bond buying, or the bond purchases now, and yet they won't do it. They'll talk about the need for interest rates to reverse and start to climb, and yet it won't happen. So first they'll try to do it from the podium in front of a microphone, and then we'll start to see if they're really going to do it. But right now, gold is climbing on the fact that it is a weaker dollar and inflation concerns and softer interest rates. So all of those things are playing a role, but the inflation, David McAlvany said this to me years ago and it really stuck. Deflation is like a dead horse. The Federal Reserve hates deflation. The dollar, it's like a dead horse that can't be revived, like the Great Depression. Inflation is a runaway horse that they feel like they can eventually rein in. Well, last week, inflation rose above 4%. We talked early in the year, January of 2021, and we talked about the fact that we'd see the CPI cross the 3% mark. And that's almost shock and awe in itself. But here we see 4% last week. And of course, stocks are going to fall, especially those growth stocks. So this is a great environment to see how things move counter to each other and in sync with each other. Get a feel for what interest rates in the bond market do when the dollar and stock markets are moving certain directions. And how does gold respond? Because to me, gold is the great reactor. It's not the trendsetter. It's not dictating to those other markets at all. It's merely responding and telling you the story. And what gold is telling you right now is, yes, if we do see that turn down that you started the show with, like if we do see some of those other lower points and serving as entry points, it's going to likely coincide with a little miniature dollar rally. But I don't see how 88 can hold. I don't see how this isn't the year that we see it drop below that and that free fall that you described actually occurs in 2021.
Well, I mean, politics. If bad news is coming out, then they try to hide it. They buy it through either distracting you from something over here, look, a squirrel's over there, or they just lie. Similar to what the LBMA did with the silver supply back in March. I mean, they came out with a number, increase in silver in London that just was off the charts. At the same time that you had huge demand, well, now they're revising this number and they're showing, oh, well, we had a clerical error or something like that.
Yeah, bookkeeping.
I mean, who can trust that system?
At the same time of the Reddit. That was the exact same time as the Reddit Wall Street bets.
So there's no wonder why they put some ridiculously high increase in the supply of silver in London at the same time that a lot of people are talking about buying silver to hurt those big bullion banks.
Squeeze the supply.
So, distract, lie, that type of thing, and then revise later. That's kind of the key. So again, from the podium, you might see some of this talk of trying to strengthen the dollar, but ultimately that 88 breaking 89, once it breaks below there, it's a free fall.
Well, another thing that could actually cause a dollar free fall is geopolitical tensions. The deeper we get into immersing ourselves into tense geopolitical situations, picking sides, you start to lose sort of global stability, whether it's our allies or people that are completely unrelated to us in a sense. And yet, this administration is going a completely 180-degree different direction than the previous administration with a lot of the alliances that we have with funding or the pulling back of funds. And so everything's got a little bit of turmoil going on right now. Another reason that you could see the dollar rally is just other currencies that it's measured against. Remember that dollar index? You guys have described this ad nauseum on this show. It could be a euro decline. It could be a yen decline, to where you see those just relatively have things occurring that are driving them down disproportionately more than the US dollar. It does not mean that we're expecting there to be a dollar rally in terms of the purchasing power. So keep your eye on the costs of things, whether you're filling up at the pump or filling up your stomach, right? Those are the things that you really need to be looking at, and then see if there's really a sea change in the spending plans here domestically, because we're approaching 29 trillion. I mean, we're counting, it seems like every month we're going up $1 trillion in the federal debt. And I sent out at the beginning of the year that we really expected us to see within the year a $30 trillion debt. And now we're just going to blow through that. So unfortunately, those are all the right reasons to, again, be diversifying into the tangible precious metals and have privacy in your assets.
So that's going to do it this week for Golden Rule Radio. We appreciate you stopping by. As always, if you liked what you heard, hit the subscribe button, ring the bell. You can head on over to our website for more info. We're at McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of the advisors at McIlvaney ICA, you can give us a call at 1-800-525-9556. Thanks for listening and hope you have a great week.